Welcome to the newest episode of the YVR REMO show. It's a great show today. We're talking about investing, leveraging your existing property to buy a rental property. Tips, strategies, process, timelines, everything you need to know was covered in this episode. It was a really good one. If you haven't already, please subscribe to the channel. Follow us on our social channels as well. And if you guys have any feedback, please do let us know.
All right, we're back for another episode here, and we have all the guys in person, which is nice. We've been doing a lot of these podcasts digitally, and so it's always nice to get back into the same room and toss it around. Today's episode, we're going to touch on leveraging your home to buy an investment property. This is a strategy that a lot of our clients have taken advantage of over the years, and it's a topic we've talked about a lot. So, some new concepts, some new strategies to kind of uncover here. So, yeah, looking forward to getting into it. And today we got Tyler, Derek, Justin, and myself all here to toss it around. So, yeah, Derek, why don't you jump into it?
Yeah, I mean, I'll probably just start off kind of with some high level, kind of basic information so everyone can kind of get a grasp on what we're talking about here. And it's interesting. I've been doing this for about 10 years, and I'd say in the last 5 years, like the concept of real estate being an investment has become far more popular. I think that's very driven because of social media. There's a lot more education out there. But a lot of people don't think of their primary residence as an investment, yet it's probably the bulk of their net worth when you really look at it, especially where we live, Greater Vancouver, Fraser Valley. If you've been in the market for the last 3, 4, 5 years, I mean, you probably have a decent amount of equity in your property. What we want to talk about today is leveraging that. How do you get access to the equity? How does it work? Best strategies to do so. And then essentially drawing equity from your existing property to create a down payment on a rental property. Maybe we could just start off, Tyler or Justin, if you guys want to dig into the process of extracting equity from your home. Like, what does that look like?
I guess if we think about the transaction type, it's structured like a lot of the steps are similar to what you would go through when you were completing a purchase, right? You're approaching either an existing lender or a new lender and applying for a new loan. It's a little less time sensitive. You're not under the gun. There's not as much pressure in terms of a subject to financing date. You got to close by this date. But the process is very similar. You're still applying for the mortgage. You're still collecting the same documentation. There's still a credit check involved. Probably the biggest piece to know is so much of what you can pull out. Obviously, it depends on what you can qualify for, but it's the value of the home, right? Because there's restrictions on how much you can borrow on your property. You can only borrow up to 80% of the value of your home. So, for example, if you have $1 million property, that would mean up to $800,000. So, the steps are very similar to what you would go through on a purchase. It's just a little bit slower pace, and it's just important to keep in mind the equity piece that you can only attain up to 80% of the value. And I guess, taking the next step further, there's different products you can consider, right? If you don't want to initiate the cost of borrowing right away, tack onto your mortgage, you can always look at adding something called a home equity line of credit or a HELOC that will give you instant access to that equity to tap into, so long as you can qualify for it, which is sort of the if you can pull it off, probably the best way to go, especially if you don't have a property in mind and you want to set yourself up to purchase in the near future.
Just some really easy numbers for anyone listening. If you're kind of curious how much equity you could potentially draw out, like Tyler said, $1 million home, times it by 0.8% or times it by 0.8, that gives you an $800,000 max mortgage. If you have a mortgage on your property right now of $500,000, take $800,000 minus $500,000. That means you can pull out roughly $300,000 if you qualify to do so. Income qualification, credit, everything that goes into a typical application.
With that, though, the money that you use for purchasing this rental property is a taxable benefit to you. It's a little bit higher advanced kind of strategy, but that is something that even if you were just to take out a bigger mortgage and don't even look at the HELOC portion, you get to write off the interest on that $300,000 for buying the next property.
Yeah, I mean the kind of concept behind that, and it doesn't even have to just be selected for real estate, but if you're pulling equity out of your property and you're using it for the purpose of investing, it becomes a taxable benefit.
Everything in investing, it's always like your return on investment, right? Like how much you put in and what's the return you're getting. Something that, like, obviously it took me even time to wrap my head around is you factor in that tax deduction from where you pulled the money to actually increase your return on your investment, right? Normally you would just consider the rents minus the cost of the home. Let's imagine your total rents were $3,000, the total cost were $2,000. You think, okay, I'm making $1,000 a month. However, you've also got this tax write-off in the background that's actually working to increase that return on equity. So it's actually a greater number than just that $1,000 example I've given.
What comes to my mind, just being involved in so many of these transactions, is timing and making sure you're prepared. And what to do from a preparation standpoint is definitely ensuring that if you are going to be refinancing your home or adding a home equity line of credit that maybe doesn't exist yet, so this is in regards to like tapping into the equity. If you don't have access to that equity right now, we have to put that file together. That's something we should be doing before you go out and start shopping, especially before making an offer on a property. And the reason being is those types of transactions can take time. 3 to 4 weeks in some cases, just to ensure that money is available in hand to be able to go then make that offer and put the money down as a deposit when your offer is accepted. So super important to just ensure that we are well ahead of that and we have that in place and funded before making the offer. So always just touch on that, because we've all been in those situations where the client comes to us and said, hey, I got an accepted offer, and we're doing these two transactions at one time. It can be very stressful for us and especially the client to try to put those two transactions together at the same point in time.
Yeah, huge challenge with that as well is, I'm sure most people have heard of the stress test, where we essentially, if there's an active mortgage application that we're trying to get approved, you have to qualify it at 2% above your actual borrowing rate. If we have to submit two applications at the same time to the same lender, we're stress testing both deals at the exact same time, which can really, really negatively impact qualification. Whereas if that refinance was done and in place, like Dean mentioned, that new mortgage had funded, the cash is in your account, we can use your base mortgage payment. There's no stress test factored in on existing mortgages if they're funded. So again, we've pre-qualified for people. They didn't want to get started on the refi. They come back with a purchase and they actually don't qualify to do both at the same time. So that's a major consideration. In addition to timing and just being prepared and making your life a lot easier, you actually might not qualify for the same amount. We won't.
I think too, like a lot of things that consumers don't understand is not all lenders look at rental income the same. So you might find this amazing property that maybe cash flows, like Tyler said, $1,000, but because you're working with ABC lender, the income going towards your qualification is not the same as going to XYZ lender. And so, maybe they have a preconceived notion of why they want to stick with said lender, but that may be hindering how much they're actually approved for as well.
I was just going to say that's a great point, because especially when you're investing, it's less about, and this is, coming from the mortgage guy, like it might sound funny, but it's actually less about the rate when it comes to investing in a mortgage and more about the product, especially depending on what you're trying to achieve. Because banks, credit unions, mortgage finance companies, trust companies, all these different lenders that a good mortgage broker will have access to have different treatment of that rental property. And sure, you might get a rate that might be 0.1, 0.15, maybe 0.25% cheaper at one major bank. But if you're going to qualify for $100,000, $200,000, $300,000, $400,000 less because you're taking that sharper rate, I mean, that's taking out an entire segment of the market that you could be purchasing. Or if you went to a different lender, maybe paid a slightly higher rate, suddenly you're purchasing a property that's worth more, which is going to increase your return on investment when that property value appreciates. So just to tack onto that, it does become a little bit less about the rate and more about finding the right product and going to the right lender. And no,
I mean, that's a great point. And it is quite common that we see a client have mortgages with multiple lenders for these exact reasons. Again, back to the point of, what started this off was just ensuring that we are prepared and have this done before going out into the market and making that offer on the investment property. One thing that comes up quite a bit too is, especially right now, is clients are eager to do a transaction like this, but they're concerned about losing the current rate that they have on their current home. So, looking at potentially a refinance option, maybe they have a low fixed rate and with a 2 or maybe even a 1 in front of it. These are very low rates that don't exist today, and clients want to preserve that rate and not lose it, and maybe are shying away from a transaction like this because they ultimately just don't want to risk losing that rate. The good news is, depending on what lender you're with, the good news is you can preserve that rate and add a home equity line of credit product for the equity that you need to obtain to buy the rental property, or looking at like a second mortgage product, depending again on the lender and what you currently have registered on title.
Yeah, really good point. And I mean, just on this whole lender piece, like, this falls into so many different categories of lending. People who are self-employed go to their bank. Their bank doesn't have a program for someone that's a business owner, and then you walk out of there with your tail between your legs, and you think that there are no options, right? So just for anyone listening, like understanding that different lenders have different programs and policies, and some are super aggressive with rental income, and it's because they understand the rental market and they're okay having a lot of rental mortgages on their books, whereas other lenders, maybe their investors aren't so keen on rental mortgages, so they quite literally just don't have programs and products that are advantageous for someone trying to buy a rental property, right? So just for anyone that, just historically, if you've applied with your bank and been shot down, it doesn't mean that there are no options. Oftentimes you literally just have to go into a different institution, understand how they structure a deal. And I kid you not, comparing bank A to bank B could sometimes mean an extra $300,000-$400,000 in financing just because of how they look at rental income.
The same bank will look at rental income differently depending on where the transaction occurred or where the mortgage loan originated. Did it come from an in-branch staff or did it come from an outside business partner? So I think that just highlights really working with somebody who's well versed in rental mortgage products, because the spectrum of guidelines is so vast with rental income. We've got lenders that love rental properties, and you can tell which ones don't like it or deem them a lot more risky, a lot more conservative. And even on that point too, just touching on rates, like important to keep in mind, if you are shopping for a rental mortgage, you will see a slight rate premium on your mortgage, and that's because it is deemed slightly riskier than a primary residence and owner occupied purchase. So just be prepared. The rates are slightly different. It's not earth shattering. You're going to see anywhere from a 0.05 to 0.1, maybe 0.15% difference on your rate term, at least from a AAA lender. But that premium can increase. The reason for that is if you look at the vast amount of foreclosures that happen in the marketplace, and I know this from working at a bank for a number of years, most of the time those are coming from rental properties. So banks know that. So when they look at a rental application, they deem it slightly riskier, and therefore you're going to pay a slight premium.
I think too, touching on working with the right mortgage broker or the bank people to help you get this mortgage is also working with the right realtor. Not all realtors work in finding good rental properties or good areas in town. So making sure that you have the right partners in place when you're shopping for this rental property, once you've been approved, you know what you're qualified for, is super important, because the last thing you want to do, and I don't want to hate on any one place, but like, you don't want to buy a condo in Wally where you could have a nice condo downtown Langley or something like that, right? Like, you're gonna have a much different clientele renting from you than the other.
Yeah. Oh, definitely. I mean, and it's even more in depth than just like the location. Like, you have to understand the different markets, right? Like looking at pro forma, like really understanding the cost of the property, vacancy rates, what have you. So again, just a good realtor. That people kind of underestimate that piece, because everyone's mom's brothers and like there's realtors everywhere, just like there are mortgage brokers, and it's pretty easy to pick someone just because it was referral. Like, you really need to dig in and understand their experience. And you talk to a realtor that's doing 1 or 2 deals a year, right? Like, they're probably not that up to speed on the market and what's going on compared to someone that's entrenched, right? Like, day in, day out, they're working with different clients in different situations. Like, they're going to help you get the deal done when you find the right property.
Yeah, I mean, finding the right property, like, of course, a realtor, giving you good advice on the areas like you guys suggested. I mean, even doing your own research. If you're not familiar with an area, we've talked about this in the past, like going for walks. Like, if you have a dog or what have you, go for a walk in that area, walk around the neighborhood, get a feel for it, and do it at different times of the day. You're probably going to see a very different um, scene walking around at night versus morning and afternoon. And, just kind of getting a feel for the area is important. And, if you are buying a property that would potentially house a family, like making sure you're near a good school and just all the things that you would look for if you're buying your primary residence. These are things that you should consider when looking at a rental property. And again, like, the demographic is huge. Like, you could be, a 2-bedroom condo or a 1-bedroom condo could maybe be looking for the right professional that has access to transit and what have you. These are all things that a good realtor will help you with. One thing that we really hone in on is the numbers, and looking at the numbers and making sure the numbers work. And that comes down to a pro forma and understanding, okay, what is the average vacancy rate in this current market right now? We probably, anywhere in the Lower Mainland, you probably have next to zero. They vary from municipality to municipality. Like, it can be quite a different number there. And even just an extra $1,000 a month could could mean cash flowing or not cash flowing on that property per month, right? So really looking at the numbers and using a really detailed pro forma, which we share with our clients. Knowing the numbers is super important, and being conservative with those numbers is crucial.
Now, this is a little off the cuff, but what do you guys generally tell your clients is good? Like, so a lot of my clients, for me, for particular buying rentals, is as long as they're covering the cost of said property, I'm saying it's a good investment for them. So they maybe have $300 coming out of their own pocket to pay down the principal.
I was just going to say, I mean, it's a really good point, right? You were talking about cash flow. I mean, where we live, properties are expensive, rates are higher right now. Like, it's pretty rare if you're going to put 20% down that you're going to cash flow locally, right? Like, maybe if you get on to Chilliwack, you're looking at duplex, whatever, you could find some cash flow. But a lot of these properties that we finance, people are out of pocket $100, $200, $300 a month. And, you know, I think for someone that maybe this is their first rental, you look at that and you're like, this is an awful investment. It's costing me money every single month. But you got to look at it over the span of, like, even just look at a 5-year line of what that property's done, like the principal pay down, potential appreciation. And really, like, if you look at that in over 5 years, let's say it works out to 50 grand, which I think is very conservative depending on the property and everything else. If you've made $50,000 from principal pay down and appreciation, and you've put $200 a month into that property, like, where the hell else can you do that? Right. So yeah, if you're out of pocket, I think just back to Dean's point, like, your expectations have to be there. The last thing you want to do is buy a property, then realize you are out of pocket and you can't afford that. Right. So knowing your numbers up front is definitely important.
My first rental was cash flow negative. I was supplementing at one point upwards of $150 to $250 a month. I was okay with it because the way I rationalized it was like, okay, well, I was contributing $150, $200 a month to my old work RRSP, right? I no longer work there, so I was like, this is my investment. This is my retirement investment. This cost is going to benefit me down the line. I was comfortable with that outlay because that's how I rationalized it. And if even we walk back the numbers to the very basic, I remember the first time anyone approached me about real estate investing, I started looking at it. Just imagine you had $100,000, right? You want to invest $100,000 today. Let's say you go buy a GIC. You can get a return of 4% on average. Like, after 12 months, you're going to have $4,000. That $104,000 is, or $100,000 is now worth $104,000. If we just take that same basic concept, you buy a rental property for $500,000, 20% down is $100,000. There goes your $100,000 investment. Let's say property values appreciate 3%. You've now just appreciated from $500,000 to $515,000. So you've made $15,000 just on appreciation compared to the $4,000 you would have on a GIC. We're not even talking about the principal pay down. Maybe you pay down another $10,000 of your mortgage over that time frame. So suddenly that 15 has gone to $25,000. So that was probably the most enticing piece of information I ever got when I decided to get into real estate investing. And to Derek's point, it's always, real estate should and always be sort of a longer term play, right? Looking down the line. But if you do find yourself in a situation where you're somewhat cash flow negative, if you know that going in and you've prepared for it, you can rationalize it pretty quick.
Well, I think too, like with your tenants, once they move out, I found with my properties, they're about a 2-year lifespan, give or take, but my rent goes up when they move out to the next tenant, right? To whatever market rates are. So you might only be cash poor or cash negative for, like you said, 2 years or a year, depending on how long your tenant's there. So that could change literally overnight. For you now could be cash positive.
If the strategy that we're talking about, like, if you've made money on your property, it's appreciated, you're leveraging that to go buy another property, like, you actually haven't put your own cash into this necessarily, right? Like, it's kind of just fun house money that you're using, and it's allowing you to invest into something that, even if it made no money, like 30 years later, it's going to be paid off. And you have this asset that's now bringing in, whether it's $2,000 or $3,000, $4,000 a month, right? So again, like, for anyone that's self-employed, it doesn't really have a pension plan, real estate can just be massive, right?
Yeah, I just want to touch on, like, just the idea of putting money away in regards to, like, being in a deficit. Like, it really depends on your comfort and your budget. So, like, really knowing your personal budget is important. Maybe look at that as, maybe that could replace that allotment of savings that you're doing. And this is almost like a forced savings plan. So if you are short $300 a month after all your costs, look at it that way, a forced savings plan, and then maybe allocate some of the money that you were putting towards your savings to that direction, because ultimately $300 shortfall on a a rental property is probably going to far outweigh what $300 put into a savings account would be. I'd almost guarantee you that that ROI would be significantly higher. So looking at it that way is a good way to kind of get over the mental hurdle of just being short. I know some clients, for especially first time investors, struggle with that idea of being short every month. And I think the better way to mentally look at it is a forced savings plan. Outside of that, I mean, I guess just to kind of summarize, like, understanding like the timing, the leveraging of your current real estate to buy, understanding that, there are different lender products and policies for each and every one of these scenarios. And, just kind of understanding the strategies of preserving rates and looking at HELOC options. What else, outside of knowing your numbers, what else could we, kind of touch on here?
Well, if you don't quite have 20% down in equity in your property, you can also look at turning your current property into the rental and getting into the next property with as little as 5% down. That's a lot of like first time buyers will do that to, they've maybe been in it for 2 years. You kind of rode a happy market and looking to get maybe from a 1-bedroom to a 2-bedroom condo or a 3-bedroom condo, the next thing. So that's another strategy that I know we all implement with kind of our first time buyers, first time investors.
Yeah. Yeah, it's a great strategy. I guess my kind of final comments on all this is, we just talked a lot about like locally, you're not going to have cash flow. And one thing that we do in our process is understand what's important to like the buyer, the borrower, the investor. And some people might say like, I can't do this if I'm out of pocket $200 a month, right? And just keep in mind, like if that's you, that's okay. You don't have to buy here. Like people are buying in Princeton, right? Like Merritt, like there's cash flow in these smaller locations. You go up into the Okanagan, Kamloops, Prince George, like there are other markets, and you don't necessarily have to be boots on the ground where you have a rental property. Like people buy properties all over the world for the purpose of investment. And if you have a good property manager, you can still typically cash flow after paying your property manager. So keep that in mind. And just last piece, this probably seems pretty like excessive for someone that's never bought a rental property. Maybe they bought their first home 4 years ago, and even that was challenging. Even if you struggled to qualify when you bought your home, utilizing rental income can do wonders for an application, right? So for someone that just barely qualifies for their current mortgage, you'd be surprised, but there's a good chance that you'd actually qualify for a rental property because the lenders that we have access to can be very aggressive with rental income to essentially offset that cost, right? So just if you're feeling like this isn't possible, you just don't know until you go through the process, essentially.
Yeah, and you don't know what you don't know, right? So engaging with a good professional to kind of even kick the tires on this is a great way to kind of figure out what's possible. And the piece I would leave you with, if even if you're buying a home today to move into, a product that I always try and secure for myself and any client that can, where it kind of fits maybe their profile, is to get one of these sort of all-in-one style mortgages, right? Where you're going to have a regular mortgage component and then a line of credit in behind. And as you pay that mortgage down, that line of credit will grow. Where that becomes extremely powerful is if you're in your home for 5, 10, 15 years, that line of credit will grow and then you have instant access to that product. And what a lot of people don't know is once you use that line of credit, like let's imagine you're sitting on a mortgage of $400,000 and you have a line of credit of $150,000. If you utilize that to buy a rental, you don't need to keep it floating in a line of credit if you're in the right product. You can actually take that owing balance and convert it into a 1-year, 2-year, 3-year, 4-year, 5-year fixed. And that makes structuring the payments a lot easier to rationalize and as well calculate the amount of income tax you can write off. So even if it's not today, there's things you can do with your current mortgage to kind of set you up in the future if it's something you want to look at down the road.
The one neat thing about just financing in general, especially working with a mortgage broker, is we can go through these strategies together and nothing is set in stone. Like, just by, looking at your options and reviewing multiple scenarios, like, leveraging your home to buy another, or if that doesn't work, what does it look like to convert your home to a rental, like Justin mentioned, and buying your next primary. These are all scenarios we can go through, and we could have, a very lengthy discussion and an email summary of just exactly what you can do. So you can sit down and mull over multiple options and scenarios and take your time with this, right? Like, this first conversation could maybe mean that, hey, you now know your options, but it doesn't lead to you doing anything for a year, 2 years, what have you. At least you started the discussion, you started to mull over the scenarios, and you know where you stand. You have a baseline of where you stand now. And so that's probably where I would leave things off, is just don't hesitate to reach out, to look at your options and start making a plan. Other than that, I think we'll end it there. I think that was a great episode. We got a lot of good tips there, a lot of good strategies, and yeah, looking forward to the next one. Thanks for listening. And if you haven't subscribed, please make sure to subscribe to our channel. And if there's any topics you think that we would or you would benefit from us speaking on, we'd love to hear it.